wondering if it knows anything like that.
Our portfolio consists of 44% women-owned businesses. We work with Main Street businesses. We don't work with tech companies. We're not.
So retailers mostly.
Retail, a lot of food-based businesses, local food-based businesses, transportation, home health care, home
Obviously, that's
daycare,
what we do healthcare.
and some light tech service, service business service industries.
Is there one or two of those that seem to have more growth potential in your mind, or are they all pretty?
We have seen some growth potential in a couple of our home health care companies. We've gone from 3 or 4 people to 60 or 70 jobs, and then some of the restaurants have grown to multi-location chains, or the same owner has several businesses. So we employ 40, 50, 80 people as opposed to 5 or 6.
Let me just make a statement, and then I'll ask you all to react to it, because the CFPB was created, and Dodd-Frank itself, to protect consumers, those that have been harmed, and Mr. Cole talked about some of the unscrupulous lending behavior. Subprime loans, certainly we're well aware of that. My fear with everything that I've heard today, I'm seeing it in my district. Mr. Hanning said you're no longer, or at least you're hampered now sometimes in the lending to your longtime customer because of the way they're rated or because of other issues. That in the pursuit of extending consumer protection, we're really hurting or have the potential to harm those people that are falling in the questionable category. There's more of them. There's less availability of credit. Credit has tightened up. If you're spending $50,000 and you're spending $60,000 for a compliance officer, that's $50,000 or $60,000. You're not lending on a car loan or a small business loan or whatever. And so obviously in the examination process, the riskier loans and the riskier consumer is going to be the one that's going to get shut down first, because it's going to make your balance sheets and everything else, your ZIMs, look less favorable if you keep engaging in those kinds of. Am I going down the right path here? And this is something I'm very concerned about, and I'm certainly for credit union. And we'll just go down real quick if you all want to make a quick statement, and then we'll get this.
Yes, ma'am, certainly.
If you have an anecdotal issue, that would be helpful.
Sure. And as referenced before, when certain loans don't fit inside the box, those become exceptions. Our credit union has worked very hard over the last 7 or 8 years to remove a lot of barriers in our lending policies, to really reach out and serve every member of our community, to really take seriously the credit union mission to serve people of small means.
Right.
But many times those loans, you can't have all of those. There has to be balance. So we have developed a lending program that has allowed us to enter in and engage in that type of lending. But the issue for us is the relationship we have with our examiner currently is positive. However, that can change. And with this not on my watch mentality that exists among so many regulators when they come in, that is a jeopardy. I would hate to think of what Stark County, Ohio would be like if it weren't for CSC, doing the kind of lending we're doing. Over 60% of our loan portfolio is CDE. We do it safely, we do it soundly, and we do it properly. But when the rules change, or if we don't know what those rules will be in the future, that's our opinion.
Mr. Blahan, you have a larger institution, certainly you've got to see this across your spectrum.
Yes, and I think one thing from our perspective, larger institutions, we go through the CMAR process, comprehensive capital assessment, we usually stress test.
Right.
The stress tests apply to risk economic scenarios, versus predict losses, the extent of our portfolio includes the lower quality loans. The regulators project large losses, larger than projected losses impact our
out there that still don't have great confidence in the economy yet, and they don't come in, or there are those people who just don't qualify. We have not increased our lending standards. They're the same as they were. We were conservative 7, 8 years ago. We still are. It's just the standards have not changed. There are less who qualify. Interpretation of the rule from legislator to regulator to the bank is an issue, which gets me to the point, you saw me shaking my head, not on my watch. We have no regulators, the OCC, now the CFPB, no reserve, the FDIC. Were jockeying for position at one time, and so they were a little more stringent in their examination procedures, which causes you to pull in the reins a little bit. And the issues are such that if we can't make loans, we can't make a return, we can't give the money to the capital line, to the bank, and make a mortgage issue.
That's right.
Our business, we were formed, and our mission is to help underserved and underbanked and unbanked communities and make them bankable. What's happened over the last couple of years is our portfolio, or our originations have gone from 70% startup to 70% existing business. All of the things that the gentlemen are talking about has led to our bank partners, credit union partners, community bank partners referring us more and more to customers that historically wouldn't have been exceptions, or maybe it would have made sense for them to work with. So they come to us, and what that does is it has the unintended consequence for those who were actually formed to serve getting pushed out of the credit marketplace. So we are in the business of providing opportunity and accepting risk, and that's why we get paid to do the technical assistance, the hand-holding that we do. And we still do that. It doesn't mean that all of the customers being referred are cherries or gems, but by the same token, it does have an adverse impact on who we used to serve. So that's kind of how we see this whole.
Mr. Coolidge.
Yeah, I just wanted to state that you're 100% correct, and that I think the intentions of the CFPB and others that are wanting to protect the consumer is going to have unintended consequences of the opposite. And I believe that community banks operate very much as my colleague in the credit unions. We're very similar. And I'm very aware, my sister is the president and CEO of the largest credit union in our marketplace. We compete head to head. Makes for interesting Thanksgiving. But actually we share a common goal, and that is to improve the quality of living in our county, which we both were raised and grew up in. We both dearly love it, and we both contribute back in her way and in my way. And so I'm very familiar with the credit unions and how they operate. We're very, very similar. Our focus is on everyone in that community, especially the underserved. And when you look at regulations like this Community Reinvestment Act, credit unions do not have to comply because they recognize that it's not necessary given how they function. But we have to comply, and again, it's overburdensome because again, the way we operate, we have to reinvest back in our communities. There are many regulations out there that simply do not apply to us by our inherent nature. And my recommendation would be, not that I want another regulator, God forbid, but instead of the CFPB, and Congress in Washington recognized the distinctive difference between the size of banks when they come out with the $10 billion. I don't know if that's the number, but since I'm $330 billion, I'm okay with $10 billion. But anything less than $10 billion should be treated differently. Now, our concern is that the rulings coming out from CFPB is going to become best practices, just like the stress tests of the larger banks. They're going to become best practices. Examiners are going to see these best practices and apply them to us as well. My recommendation would be the establishment of a community bank regulator, that the banks of a certain size are regulated by people that understand community banks, that we are not subject to the other regulations, but those established by a community bank regulator, made of panels and advisories of community bankers that can work through these execution issues and policy issues.
Well, I appreciate that, and before I turn the mic over, I want to reiterate that consumer protection is a huge issue for all of us and for everybody sitting here. You wouldn't still be in business if you didn't try to engage in good consumer protection. And so, you know, meeting striking that right balance is going to be difficult. Mr. Renacci.
Thank you, Madam Chairwoman. And it's interesting, Mr. Cole, I was listening to your comments, and I agree wholeheartedly. You know, we had issues, the big banks, the big Wall Street banks, and what we've done is we've thrown a blanket over everybody, which is also includes some of the smaller banks and smaller institutions, which just isn't fair. So I kind of want to put a human face on this issue. You know, there are some that say regulatory relief is really just shorthand for desire of financial institutions to cut costs or avoid burdensome regulations. I remember 28 years ago when I came to Ohio that I went to a small institution. I had a good credit history, and I borrowed some money and started a business and grew that business because the small institution believed in me. And they believed in my background, they believed in my experience. So I questioned, for example, let's talk about the customers for once. How are we affecting Mr. Barnes and Mr. Cole and maybe Mr. Haney? Put a human face on that. Do you have those people, like I was 28, 29 years ago, that come to your institutions, are looking for that first step to employ people, to start a business, to engage in entrepreneurship, and all of a sudden these regulations are stopping you from helping them?
Oh, absolutely. I myself own a business. I am a small business. Our bank's a small business. I'm an entrepreneur. We have, before I became president and CEO, I was a commercial lender. I could tell you stories of many people who came to us just like yourself, and we started them, and now are successful businesses employing numbers of people that wouldn't have gotten a start otherwise. Because other institutions wouldn't have seen the person and the character and what's behind the numbers. So as a community banker, growing up in a community, knowing people, there's a value there that extends beyond the numerical evaluation. So yes, we have people coming today, and because of the way we have to grade loans, and I'm still part of the credit committee, and I, as a former commercial lender, struggle when I hear my credit analyst, my loan people, my person in charge of loan administration says, well, you know, if we make this loan, it's going to be immediately classified, and we'll have to reserve. Seriously, and yes, and, you know, and so we struggle with that, and given economic factors, we may not make that loan. That in my heart, in my day, had I been making, I'd have made that loan all day long. So yes, that situation does.
I'm sure my first loan would have been classified. That's the problem. Mr. Barnes, any comments?
Congressman, yes, thank you. We do see many people with business opportunities that come to us that are looking for financing that has been turned down by either banks or have had lines of credit terminated. Our credit union does do some business lending, but we are not involved at a huge level. So what we usually do is try to pass those referrals on to the credit unions in our area that do provide that. But they all come with a similar story that they've gone elsewhere. And they either have lines of credit terminated or they're not able to get them, or what did qualify at one time no longer meet certain criteria or fits in that box. So certainly from a business standpoint, we see that. We also see it on the personal side, especially with residential mortgages. Any disrespect to anybody over here, but sometimes some of the larger institutions don't have an interest in doing small mortgages. And a lot of it goes down to regulation. There's a ton of regulation and compliance that's involved in executing a mortgage for a member. And that cost and that level of compliance is the same on a $200,000 mortgage as it is on a $25,000. So we see many members coming to us with small mortgages. And in Stark County, Ohio, there's a lot of people that's homeless that can charge us for that amount of money. So no credit. But he was a good kid. In fact, my dad was a high school elementary school principal. His mom was a school for my dad. This was a kid that she had in my dad from years ago. We were able to help him because of the personal relationship, which anywhere else,
Mr. Pike, do you agree with that? put you on the spot, seeing that you're a bigger bank.
I think because of our size, we tend to be more statistically good when it comes to loans, because our regulators tend to look at us and drive us statistically. We certainly try in our community branches to be the kind of personal lender that others up here are. But obviously, because the size of the institution, what we're able to do is grow this kind of situation.
Mr. Henning, Mr. Cole, financial institutions often tell me that they have no recourse when they have a dispute with the regulator, be it the FDIC, the OCC, or the Federal Reserve. In other words, the regulator is judge, jury, the executioner for any dispute or disagreement in a regulatory examination. How could the appeal process be improved in your mind, in your thoughts, and could the Office of Ombudsman be strengthened to give it more substantial power?
Congressman Renacci, I have a tendency to want to agree with that assessment, but I also feel like there is a process in place. We also have, the Ohio Bankers League has a procedure in which we can do some things anonymously and have the association pass on the rules and regulations. It comes down to the point of we need to make a conscientious decision. Is it worth the time and effort and possible retribution of disagreeing with an examiner, what the outlying result would be if we just let it go and try to comply? But having an opportunity or an ombudsman that understands is very critical. I think they have those things in place. I've not taken that process, so I can't address that specifically. But it is needed. There does need to be an avenue to share your findings without specific name and number.
Just a quick follow-up, because you said something that's very important, possible retribution. Do you believe banks fear that, possible retribution? I know a lot of times they don't want to appear in front of a panel because of possible retribution, so.
Yeah. I don't think it's anything, yeah, they'll come in and they may dig a little deeper. They may find a particular area that they want to drill down on and find possible issues. So it is a possibility. I think in general, it's not something that happens on a regular basis, but that's always a concern.
You know, I think it depends on, from my perspective, the regulator is, you know, we're a state chartered bank, so thereby we're regulated by the state of Ohio. In the audience, the director of the Department of Financial Institutions, Division of Financial Institutions. We have a direct relationship. If I've got issues, I can pick up the phone and call Chuck. You know, so I think the relationship there is different than it is on the national. From what I've heard from my peers, the OCC is a little different. I also have a good relationship with the Federal Reserve Bank here in Cleveland. I know policymakers, I can pick up the phone and call. If you're not, unfortunately, the way the system works, I think it's a matter of who you know. Also, the issue is there blood in the water? Unfortunately, what I've seen over my career is once there's blood in the water in a bank, there's very little motive for the regulator to not be more aggressive. They're not rewarded on the basis of public interest in terms of making loans. You know, they're not rewarded to see that banks, how much banks do in the community. They're rewarded on the, and I think they got unfairly punished on this last crisis. So I think they took a beating. And so if I'm in their shoes, what am I going to do? I'm going to err on the side of being overly conservative because I'm not rewarded to do otherwise. So if there's a situation out there where there's potential problems, I don't want my regulators walking away from that and not identifying everything. So I think when there's blood in the water, yes, I think they get overly aggressive, and I think the options for the individual bank are very limited. And yes, I do think they fear, at that point, having not been the CEO in that situation, but just surmising if that were to occur, I would be very compliant.
It's an interesting analogy, blood in the water. I'll remember that one. Thank you so much.
in regard to retribution. I hear a lot of my institutions telling these stories, but saying, make sure you don't use my name. I don't want my name out there associated with the story I'm telling you. And I don't want to go public. You can use it, but put a different name to it or leave it out. Just maybe a little follow-up on the ability to make this, we'd say, is it character alone, or is it, you said, informed judgment, and how that's now scrutinized? And I think Mr. Renacci made a good point. You had someone who was willing to make an informed judgment or look at his character and take a little larger risk on him. And I imagine in all our communities, our financial institutions being willing to make that kind of call have bred more success than failure. I imagine that's why you can do it, and there's factors you look at. I think that's one of the concerns I continually hear, that you can't use your judgment as a banker to invest in a business you think is the owner has good character and is a good risk. Because when the regulators come in, it'll be it'll be classified. So, I mean, is that what your is that basically what your point was, Joel?
Yes, I did commercial lending for 20 years, and I had, I think maybe I was luckier than it was good, but I had a lot of success. I only had a few, in the whole 20 years, few loans go bad. Had many businesses prosper. And yes, I used a lot of intuitive judgment and was given the flexibility at that time to do that, as long as I had a good rationale and to support the loan. Today, it's not that way. I mean, the same loans that I made then, I would not be allowed to do today. And you know, the document has to be supported numerically. And again, there's a grading system. And there's a heavy emphasis, a flawed emphasis on collateral and collateral values. That to me, that's a whole other subject in how this appraisal process is working. But again, my evaluation of collateral in my community, which I probably know better than anyone, would not be able to be used. So there's a lot of things that have changed, and we've become more sophisticated. There's modeling that must be done, which has been going on in all aspects of the banking industry. And we saw in the crisis, these models fail. These models should never have replaced intuitive judgment, should never have replaced human intelligence. Unfortunately, these models are being used as the only intelligence.
Maybe just one other thought, and I'll then yield back, but switching gears to the CFPB and consumer protection, one of the concerns we've had on our committee is we have our basic standard of safety and soundness, and then here we have the CFPB with a different standard of consumer protection, and at some point those may sing in unison, but at some point they may be contradictory, which has led us to have, I think, a lot of concern on the hearing on how we're going to deal with safety and soundness and consumer protection. And maybe echo what someone else had earlier said, if you don't protect your consumers, if you are working your consumers over, treating them unfairly, one, they'll go across the street to another bank or credit union, and you don't stay in business for very long. Now, unless you're one of the bad actors who are able to set up shop in the corner and engage. But I mean, have you guys thought through the consumer protection regulation side as opposed to safety and soundness? And has that had any points of concern for you?
It certainly has a concern for credit unions. With respect to the CFPB, generally credit unions support their mission, taking care of and making sure consumers get a good deal is at the heart of what we do, what we have always done. So we want to see that continue. And we also feel that the director certainly, we have in Ohio have a good relationship with Mr. Corbray. We believe that he certainly intends to do the right thing. With that said, however, there are issues and concerns that we do have about the Consumer Financial Protection Bureau. First of all, the existence of a single director is troublesome for us. We would prefer to see a always given their members a good deal. I'll say that over and over. And that is what the Consumer Financial Protection Bureau is in place to ensure. So if they are looking at rules and regulations and processes, even though they are not in charge of enforcement for the majority of credit unions, we still have to follow their rules. And anytime rules change, while the outcome may be the same, and consumers, our members, still get a good deal, those new rules come along with an increased cost of compliance. And then the second thing is we just don't want to see mission creep. We want to make sure that the Consumer Financial Protection Bureau really does what it was intended to do, and that is take over the administration and enforcement of those rules and regulations as opposed to adding new ones to the mix. So we're concerned about that, and we're keeping a close eye, but that's our position on that.
I was just going to say with regard to the CFPB, I had meetings last month with the director, and I discussed with him, not as related to us, but just concerns in various sectors that I've heard about the agency fear. And his message was, I'm talking to a reasonable guy, and I think everybody knows that he is, so that's my opinion. So that message.
And I've heard a lot of positive comments. The concern, as we said in the agency, will he be a life appointee? Probably not. You'll see other heads of the agency which has spread some concern, but I think it was Mr. Mr. Stiver's district, I believe. I thought it was Mr. Stiver's district. Maybe I'm wrong on that. And one of the concerns that we brought up in a bill that I introduced was the fact that if there's going to be a rule that comes out of the CFPB that's undermining safety and soundness, it can be overturned at AFSOC with the supermajority vote. I have a hard time believing that Mr. Lawrence or Mr. Cole could make that appeal to AFSOC that rule that affects you too negatively will then therefore affect safety and soundness in the country. I don't know if they're going to listen to you, but in essence, if you're bigger, and Mr. Blake, maybe not even you, I think if you have a larger Wall Street bank, though, no doubt they can make the argument. And again, you've empowered those institutions that didn't necessarily have, those institutions that were involved in the crisis, that left voiceless those who didn't have any real role in the crisis with this agency that was supposed to address consumer protection. So I appreciate you all coming in, and I know that we can have a chance to question you, but I appreciate your honesty and you want us to share with us, and I'll get back.
Do you have any other further questions? Comment?
Thank you. Just, I want to go back to the CFPB because I did ask Mr. Cordray, and Mr. Cordray is a good man, but I asked him a question last week, 2 weeks ago in the hearing, that he's walking into all of these examinations with an attorney. Can you all tell me what your thoughts are when the CFPB walks into your established, if they have, or if they haven't yet, if they did, with an attorney?
Congressman Renacci, I'd like to address that. I also met with Director Cordray last month in Washington, and I talked with one of their newly hired employees. They said their count was up to 100, and 87 of them were attorneys. So everybody in his group has a legal background. He also assured us that for the best of the order, their regulations would affect community banks. But that's not the case, because what the examiners hear in the way of review trickles down to us in the term of best practice. They don't need to learn 6 or 7 different ways of reviewing the same type of loan, so they're going to use the best practice. And although we have a good relationship with Mr. Cordray, and once again, as my colleagues here said, we're not on board with their method of reporting. We do have concerns. We do have compliance issues, and if the best practice comes down, I think we're all going to be looking at the same.
Here's an analogy I'd like to draw on, is that I think you all remember when the Cuyahoga River was on fire, and we couldn't fish out of Lake Erie, couldn't drink, swim in Lake Erie. And so there was a need for intervention by the government to put safeguards in place to protect the citizens. And having grown up in this area, I was all in favor of it. And now we have an opportunity with drilling in Ohio to have a significant economic boom in my area. And we want to make sure that the EPA, again, acts responsibly, safeguard the citizens, at the same time allow for economic development. And I see that same application as applies to the CFPB as the new EPA of the financial world. It has a purpose. I mean, there was damage that was done. There was consumers that were harmed. And I think we all want to see that fixed and corrected. But at the same time, we got to make sure that it doesn't impede economic development, because of those same citizens that they're protecting, they're going to be harmed.
I would always use the analogy, I've used it many times. I was a fireman at one point in time, and everybody thought the way to save the building was to throw more water on it. Sometimes when you throw more water on it, the building burns faster. Keep that in mind as we talk about regulations going forward. But I do also want to thank all of you. You're very honest, and I appreciate your comments. We'll work with you the rest of this year.
I want to thank our panelists and our audience, and I think we've gotten some excellent testimony. Thank you for taking time out of your busy days, particularly on a Monday, to come before us. The chair notes that some members may have additional questions for this panel, which they may wish to submit in writing. Without objection, this hearing record will remain open for 30 days for members to submit written questions to these witnesses and place their responses in the record.